With every style of investing, there's always going to be a good and bad. So in this video, I'm going to be going over the pros and cons of dividend investing. So I'm going to give you 2 pros of dividend investing and then also 2 cons of dividend investing and go into those. Jumping right into it, reason number 1 why dividend investing is great and a pro of dividend investing is that dividends are the best form of passive income. I went into this in my last video that dividend investing is the best form of passive income, and I truly believe it is because the only thing you need to do is invest your money, and without fail, the asset managers or the company itself will work to return cash to you in the form of a dividend. It is really the number 1 form of passive income because once you put money into the investment, you don't have to do anything else to work for that money. Looking at some various forms of passive income here, we do see a variety of things you can do to make money, but what you'll find is that a lot of these methods come with a lot of upfront work. In other words, you are not just putting your money into these and then the investment is paying you a dividend. You're really putting in a lot of legwork yourself to make passive income from these ideas. So, I mean, the first 3, write an ebook, that takes time, sell photography online, that takes time, and create an app, that takes time as well. And even what I'm doing right now, number 4, create a blog or YouTube channel. It takes a lot of upfront time in the thinking it takes to do videos, actually recording the videos, editing the videos, and making the thumbnail, and so on and so forth. But with dividend investing, you have none of that upfront work. All you have to do is put your money into the ETF or stock, and you will be paid quarterly or monthly, however that dividend is distributed. You will get without any labor from you forever long you hold that investment for. And personally, I think that that is the number 1 reason why dividend investing itself is popular. I am going to go into the second reason why dividend investing is great, but really to drive down, dividend investing really is a true form of passive income, and everybody does love to make money without having to work at all. And dividend investing is a great way to do that. So the second advantage of dividend investing is that dividend stocks and ETFs are generally going to be less volatile. This means that stocks that pay a sizable regular dividend usually trade in the market with less volatility than stocks that don't pay dividends. Now, of course, as this goes on to say, it is not a hard and fast rule, so that is not always going to be true, but on average, it does hold true. This little tidbit from Merrill Lynch goes into slightly more detail, and it pretty much goes on to say that dividend investing offers potential downside risk during a market sell-off. So companies that have consistently increased their dividends tend to be more stable, higher quality businesses, which historically have weathered downturns and are more likely to have the ability to pay dividends consistently. In short, a lot of companies that pay dividends do have large, stable cash flows that no matter the market, they are going to bring in revenue. If we take a look at the top 10 holdings of VIG, the Vanguard Dividend Appreciation ETF, an ETF that really encompasses what this article stated before, companies that have increased their dividends tend to be more stable, and this ETF includes companies with a history of growing their dividends over time. We look at this list and we do find companies that are large, stable, and I think that if you do look at this list, most would agree that none of these companies are going to go anywhere anytime soon, even in a market downturn. Now, of course, in market downturns, a tide pulling out, of course, lowers the ships in the bay, just like everything else. But typically, these companies will do a lot better than the companies that don't pay dividends at all. Again, these companies have stable cash flows with a large consumer base, which provides steady revenue even in market downturns. So your portfolio won't drop as much as a portfolio consisting of growth companies. So again, 2 of the big pros of dividend investing are its passive income. It is an extremely reliable form of passive income that you don't have to work for. And pro number 2 is that it withstands market corrections slightly. it provides for less volatility than the overall market in ideal circumstances. But let's get into the disadvantages of dividend investing. Of course, we want to be completely upfront and do a couple of critiques as well. So con number one, or disadvantage number one, is that dividend investing is going to have generally a lower total return than simply investing in something like the S&P 500. Here I have the Dow Jones US Dividend 100 Growers Index, an index that SCHD uses. Now, SCHD is an extremely popular dividend ETF. It stands for the Schwab US Dividend Equity ETF. I'm sure many of you own this ETF or perhaps even heard of it, but basically this is an extremely popular ETF, and that means that this index is extremely popular because that ETF tracks this index. Anyway, so the 10-year return of this index annualized is 11.2% approximately, which is a great return, and I don't want to understate that because this return does include both dividends invested and capital appreciation as well. And this generally is a pretty good return. But if we look at the 10-year annualized return of the S&P 500 index, you get a 10-year annualized return of about 12.8%. So it certainly did outperform the Dow Jones US Dividend 100 index. And I use this index because not only is this index used by the most popular dividend ETF there is pretty much, but it also is really the best dividend index there is. There's also the S&P US Dividend Growers Index, but both of these indexes are pretty much in line with each other. And even with using the best index, you still do have a bit of a lag there of about 1.5%. So year over year, the dividend index trailed the S&P 500 by about 1.5%. And you may think to yourself, who cares? So what? 1.5% is nothing. And I am here to show you that is not true at all. What I did is I did an initial investment here of $10,000, contributed nothing, and a length of time 30 years, and an estimated interest rate of 11.17%, which is again the 10-year annualized average of the Dow Jones US Dividend 100 index. And we get a final value in this portfolio of approximately $240,000. And of course, that is great. And I wouldn't really mind that either, turning $10,000 into $240,000 doing no work myself. That is generally a great return, but of course it can get much better. So now I took the S&P 500 annualized 10-year return at 12.77%. And I kept all the numbers the same, still $10,000, still 30 years, and the end result is pretty wild here. You get a final portfolio value of $368,000. So dividend investing lagged that, even using one of the best indexes, by about $120,000 there. So just keep in mind, when you dividend invest, especially over long time periods, you're going to trail something like the S&P 500, generally speaking, and held to a long term, you will see a big variance in your portfolio. The final value, of course, will generally be a lot larger when you pick something like the S&P 500. And so why is this? Why does dividend investing generally lag the wider market, such as the S&P 500? And that is simply because a lot of dividend companies are really at the maturity stage of their business life cycle, which means that there is no more growth that the company is really trying to do. They take a lot of their cash that they receive and simply give it back to the shareholders in the form of a dividend. And I don't want to make you think that because a company is mature that it's going to be on the decline pretty soon, because there's certainly definitely companies that have existed for an extremely long time that are mature that have yet to go on the decline. But maturity really is one of the last stages of the business life cycle other than decline. And a lot of the growth companies, of course, are in this growth stage. So the S&P 500 are going to include companies that are in this growth stage, and not so much, of course, the launch stage, because those are generally something like small caps, maybe or micro caps. But a lot of the new and upcoming S&P 500 companies with a market capitalization in the low 10 billion or so are still in this growth stage, which gives plenty of growth to the company to basically appreciate capital. And dividend companies, dividend stocks are in this maturity stage when they're not generating capital appreciation. They're just, of course, as I said, paying out those dividends to you as a shareholder. Disadvantage number 2, or con number 2, and that is simply taxes. Now, this doesn't really matter to you too much if you hold this in a tax advantage account, something like an IRA or a 401k, but this can definitely create tax drag if you have to pay taxes on those dividends in a taxable account. Now, dividends are pretty much taxed various different ways. There's qualified and non-qualified dividends, and basically it is determined pretty much how long you hold the stock, whether or not that company is a US company or a foreign company. It gets a little bit more difficult in various forms of distributions that you get. So not all dividends, quote unquote, are something like a standard dividend. A lot of ETFs, like JEPI, for example, or the JP Morgan Equity Premium Income ETF, don't provide a standard dividend, or at least a large portion of the income that they provide to the investor is not a standard dividend. It is really derivative income. What they do is they sell covered calls, which does pay a high amount of income, but it is not a standard dividend, at least in the way of the IRS. So you're not going to be taxed at an ordinary rate. That is generally going to be taxed at whatever your tax bracket is. So if you have a lower tax bracket, qualified dividends are taxed at pretty standardized rates. So depending on your tax and income filing status, there's a 0%, a 15%, or a 20%. And that is standard no matter which tax bracket you may fall into. Even if you make, hundreds of thousands of dollars a year, it's either going to be 0 if you make pretty much nothing, 15% if you're kind of like middle class or upper middle class, and 20% if, your income is in the hundreds of thousands of dollars per year. But that is as simple as it gets. Now, if you get a non-qualified dividend or an ordinary dividend, you are going to pay at a far higher rate, which really isn't that bad in general, because here's first off, the rates for the qualified dividends here. So pretty much, as I said, you are going to be paying 0% up to 47,000, 15% up to 47,000 to 518,000. I would love to make that amount of money. Let's call it 519,000 and above, you're going to be paying 20%. But if you are in the non-qualified dividend area, you are going to be paying whatever your income tax bracket is. So I think in the US currently, could be wrong, it could be up to 39%. So whatever those dividends are, it gets added into your overall net income for the year, and then you pay at your tax bracket. So of course, the US uses like a marginal tax bracket, so you're not paying 39% on all of it, but at the same time, you are still going to be having to pay much higher in taxes over the long term. So just a little recap, 2 advantages of dividend investing are its passive income qualities, really the best form of passive income in my opinion that somebody can get, and it also provides for less market volatility, and in economic downturns, you may suffer less. 2 disadvantages of dividend investing are, in most cases, over time, you are going to underperform growth stocks or growth assets, and also you are going to be taxed on those dividends, which of course could provide tax drag depending on the account you hold it in. If you did appreciate this content, leave this video a like to get this content out there to a wider audience. It would be greatly appreciated. And also, if you want to keep up to date on the latest videos, consider subscribing to keep up to date on future content. And I will see you all in the next video.